At CNBC Global World Headquarters, we have Federal Reserve Governor Jay Powell. Thanks for joining us, Jay.
Great to be here, Steve.
So, I mean, the talk of the markets right now is the level of the market. We zoomed through 20,000 and we got to 21,000 before we even know if 20,000 was the right level. How do you as a policymaker look at these levels and this rise in the stock market since the election?
Yeah, so you're right. The stock market has been quite strong since the election. And of course, it won't be a surprise to you that I don't have a position for you today on the level of the market. But what really matters from our standpoint is the extent to which the animal spirits get into the real economy. So probably the stock market has to do with expectations of supportive fiscal policy and stronger confidence by households and businesses. And those things take some time to get into the real economy, show up in spending and investment and that kind of thing. So that's what we're really looking for.
You used the phrase back in early January that you didn't think asset prices were, very good Fed phrase here, not broadly unsustainable. That was 5% ago. You're laughing at yourself here. I mean, I guess that's what you guys do, but was not broadly unsustainable. Do you still think that this level, 5% higher, it's not broadly unsustainable?
Clearly, I've been working at the Fed too long. Yeah, no, I think that's probably still right. And, asset prices they're going to do what they're going to do, and they certainly have had quite a run here since the election. I think from our standpoint, what's more important is the things we look at are buildup of credit in the economy and the growth of leverage in the economy. And you really don't see credit aggregates or leverage going up much, so we don't have broad financial stability concerns. And asset prices, they're different assets that are priced different ways.
So these are not valuations that cause you concern about, say, systemic risk?
No, I would say not.
Let's move on. Yesterday, we got some economic data that caused several forecasters to lower their forecast for Q1 GDP down below 2%. What's your sense of the momentum in the economy right now?
I think the momentum in the economy is solid. We've had 2% growth. At the beginning of this year, I think I was looking at 2% growth and continued progress in the labor market, inflation continuing to get back up to 2%. And I see us as broadly on that path. You really can't be too attentive to short-term movements in GDP. We don't measure GDP particularly well in real time. So you've got to look at it in terms of quarters and halves and full years. And I do think we are right where we need to be.
Do you see the United States getting any help from abroad? Does it look like the global economies are also growing as well?
Yes, for the last few years, we've really had significant global risks and weak growth abroad. And I think that the risks have diminished, and actually, growth in Europe is a little stronger, inflation's a little higher. Same is true in Japan. So we see a slightly brighter picture abroad, and I think that will help us.
Speaking of inflation, we got some data yesterday. The two measures the Fed follows most closely are the core and headline PCE. 1.9% on the headline, 1.7% on the core. Are you ready to declare victory? Are you at your goal here?
We're getting very close to our goal, and we've been very close. We seem to be gradually moving up to 2%. The goal, of course, is 2%, and we see that as a symmetrical goal, meaning we'd be equally disturbed to see inflation above or below it. So I think that if we keep sort of on this path, we'll get up to 2%, and we're certainly getting very close.
And what about the unemployment rate at 4.8? Is that the sustainable level of unemployment, or do you think there's more slack in the labor market?
That's a pretty good centrist estimate of what the sustainable level of unemployment is. There's tremendous uncertainty around that, though. No one really knows. It's not something you can directly observe. There are probably pockets of slack existing in things like people working part-time for economic reasons. There are probably people hanging around the edges of the labor market who are not counted as unemployed, but who could come back in a stronger market. So I think you look at the behavior of wages really to tell you how tight the labor market is. Wages are ticking up, but they're not ticking up a lot. It's quite a gradual thing. It suggests to me there's probably still some slack.
So when you put all that together, how close you are to your inflation mandate, how close you are to your unemployment mandate, how does that instruct you for this upcoming March meeting in terms of raising rates?
So I think we're as close to our mandates as we've been in a very long time. And as I said last week, I do think that a rate increase at the March meeting is on the table for discussion. And the reason I think that is that the economy has behaved pretty much as we expected. In the meantime, the balance of risks, which has been to the downside in recent years, has really shifted to being even and perhaps lifted to the upside because of the possibility and indeed likelihood of some fiscal action. So you put all that together, and I think the case for a rate increase in March has come together, and I do think it's on the table for discussion.
There's two questions out there for the market. One is when that next rate hike comes, and sometime in that March to June period. I mean, already we're at 75% of the probabilities for March. But another is how many? Are you, even if you went early in March, would you still think 3 seems about right this year, or should we start thinking about a 4th rate hike this year?
You know, it all does depend on the path of the economy, and no one is particularly successful at predicting the economy more than a few months out. But I wrote down 3 rate increases in the September summary of economic projections. That still feels about right to me. That's a gradual path by any historic measure, and it does feel to me that's about right. But it is really going to depend on what the economy does. It could be higher, it could be lower.
I know we get into a series of hypotheticals here, but it is important for the market to know about your $4 trillion balance sheet. If you complete those 3 rate hikes, do you foresee possibly at the end of that or sometime during that reducing the size of the balance sheet?
So the way I look at it is the interest rate, changing interest rates is the principal tool by which we affect financial market conditions, and that is our monetary policy tool. And I would like to use that tool. The balance sheet tool was deployed when we were at the zero lower bound during the height of the crisis and thereafter, and that's for extraordinary circumstances. So I'd really like to see us get well above zero, well into the normalization process before we start shrinking the balance sheet, because shrinking the balance sheet is a way of removing accommodation. So I'd like to be well away from that, and I would say that's going to take a little bit of time in my thinking. And then when we do go to shrinking the balance sheet, we can do it in a very predictable, almost automatic way.
Does that seem like it's a task for this year, reducing the balance sheet?
You know, we're just going into a series of discussions about that, and I'm gonna you know, keep an open mind for my discussions with my colleagues. But that's how I've been thinking about it.
You talked about the difficulty of predicting the economy in the future. One of the big wild cards is the fiscal stimulus that could be coming from Washington. What do you expect from there, and has it already caused you to change your growth outlook?
So we don't know the scope of it. We don't know the timing of it. We don't know the composition of it. I don't know any of those things, and I don't think anyone does. We haven't seen proposals yet. We haven't seen Congress draft legislation. We haven't seen the negotiations. So it's very hard to be specific. I think about as far as I can get in thinking about this is to think it's very likely there will be something, and it'll probably be something that is supportive of growth in the near term. So I've not directly incorporated that into my forecast, but I do think of it as giving me more confidence that the baseline forecast will be reached, because it does kind of tilt the growth risks to the upside a little bit.
Are you also tilted by higher stock prices as well as higher confidence levels? Does that factor in to your forecast to make you think there could be more growth coming because of those 2 factors?
So those 2 things are important, but they have to be sustained if they're going to affect economic behavior. And so I would hope that they will be sustained, and that we'll see animal spirits bringing people into you know, spending and investing.
President Trump has several appointments he could make right now. Several people are leaving the board. What kind of changes do you expect? Do you have concerns about the kind of changes that could be coming from the new president?
I have no concerns. I'm looking forward to meeting new colleagues, and you know, I look forward to meeting people. I'm eager that there be a vice chair for supervision as soon as possible, so I can begin to work with that person.
And you're going to stick around?
I have every intention of sticking around. Yeah, I really like the work a lot.
Well, thanks for joining us, Fed Governor Jay Powell.
Great to be here, Steve.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.